One of the strangest things about markets is that the products people trust the most often become dangerous for the very reason they are trusted. That is not a contradiction. It is one of the oldest patterns in finance. A good idea becomes a popular idea becomes an easy idea becomes a crowded idea, and a crowded idea eventually becomes a fragile idea. That is the cycle. The public usually notices it only near the end, when what felt safe suddenly begins behaving like a trap. I have watched this happen over and over in different forms. The names change, the wrappers change, the sales language changes, the technology improves, the pitch becomes smoother. But the underlying human behavior remains almost perfectly familiar. People stop buying something because they understand it. They stop asking what is inside. They start trusting the label on the outside. And once that happens, the risk is no longer only the underlying asset. The risk becomes the crowd itself. That is why I want to speak plainly about something many people assume cannot be dangerous, because it looks diversified, liquid, modern, and respectable. Exchange-traded funds. I am not against ETFs, far from it. A properly structured broad market fund, owned for the right reasons, at a low cost, can be one of the most useful investment vehicles ever created for ordinary people. That is not the issue. The issue is that investors have taken a good tool and started using it in very foolish ways. They see the ETF wrapper and assume diversification. They see popularity and assume safety. They see strong inflows and assume quality. They stop doing the work that must still be done underneath the wrapper. That is where the danger begins. A fund is not made safe because it is listed. It is not made wise because millions of people own it. It is not made diversified because it holds more than one stock. And it is certainly not made cheap because the expense ratio sounds low next to an actively managed mutual fund from 20 years ago. A serious investor must still ask the old questions. What exactly does this thing own? How concentrated is it? What is driving flows? What happens when those flows reverse? How are the underlying assets valued? How liquid are the holdings? How much of the apparent safety is real and how much is just social proof? Those questions matter more today than ever because we are living through an era in which people increasingly buy wrappers instead of businesses. They buy categories instead of cash flows. They buy stories instead of economic structures. And once enough money piles into the same wrapper, the wrapper itself starts shaping the very market it is supposed to merely track. That is not always healthy. In fact, it can become deeply unhealthy. When too many dollars flood into the same ETF, several things begin to happen. The first is price distortion. Money flows in. The fund must buy more of the underlying holdings. It does not stop to ask whether those holdings are cheap or expensive in a business sense. It buys because the money arrived. Now the act of buying itself begins to support and elevate the price of the underlying securities. That creates a feedback loop. Higher prices improve recent performance. Improved recent performance attracts more inflows. More inflows require more buying. Soon people begin mistaking fund flow mechanics for investment merit. That is a terrible confusion. The second problem is crowding. If millions of investors own the same fund for the same reason, then their diversification may be much weaker than they think. They all tell themselves they own a prudent vehicle. In reality, they may all be standing in the same doorway. That is fine when money keeps flowing in. It is much less fine when sentiment changes. Then the thing that looked safe because everybody owned it becomes dangerous because everybody wants out together. The third problem is emotional complacency. This may be the worst one. Popularity creates borrowed conviction. People say everyone owns this, so it must be right. They stop questioning the valuation. They stop questioning the concentration. They stop questioning the sector mix, the methodology, the tracking logic, the underlying assumptions, the structure itself. They treat consensus as due diligence. That is an old and expensive habit in markets. Consensus is not due diligence. Consensus is often just the latest stage of a trade. What concerns me now is that several famous ETFs have become so widely owned, so deeply loved, and so structurally crowded that they no longer represent sensible long-term investing for most people. Again, I am not accusing the sponsors of fraud. That would be the wrong point entirely. The problem is not that the managers are evil. The problem is that investor behavior around these products has created distortions that make them poor tools for serious capital allocation. I want to walk through a few of the most obvious examples because they reveal different versions of the same disease. The first is RK. When I look at RK, I do not see an investment vehicle in the conservative sense. I see a bundle of hopes that became fashionable enough to masquerade as a portfolio. That distinction matters. A portfolio should have some relationship to business reality, to earning power, to survivability, to valuation. RK became popular in an era when markets were desperate for growth stories, flush with easy money, and emotionally eager to believe that technological transformation could excuse almost any price. That is a very dangerous emotional climate. In such climates, the difference between investing and narrative worship begins to disappear. People stop asking whether the companies inside the fund are profitable, durable, competitively advantaged, or sensibly priced. They start asking whether the future is exciting enough. Excitement is not a valuation method. A great many of RK's holdings were not established compounding machines with proven economics. They were businesses asking investors to pay heavily for a future that was still speculative in important ways. Some had limited current profits. Some had no profits at all. Some relied on very optimistic assumptions about adoption, scale, execution, and capital access. This is not what I call investing in the old-fashioned sense. It is thematic speculation organized into a basket. And then investors made a second mistake. They paid a high fee for the privilege of owning concentrated speculation. This is one of the oddest habits in modern finance. A person can buy a broad market index at very low cost. Instead, he pays materially more to own a smaller set of riskier, more concept-driven companies, all because the story feels more modern. I have no objection to paying for true value, but you should know what you are paying for. In RK, investors were often paying up for concentration, for narrative intensity, and for active opinion layered on top of speculative growth names. That is not my idea of value. Then the real danger emerged, inflow mechanics. As the fund performed well, more money rushed in. The new money had to be deployed. That deployment helped push up the underlying names, many of which were not the deepest and most liquid securities in the world. That price support made the fund look even better. That better-looking performance attracted even more money. The cycle fed itself. This is the kind of market structure that feels brilliant, while it is working and deeply fragile once it turns. Once sentiment changed, the same mechanism ran in reverse. Flows reversed. Selling pressure mattered more. Illiquid or less liquid positions became harder to exit gracefully. The fund that had once benefited from a self-reinforcing upward loop began suffering from a self-reinforcing downward loop. That is not an accident. That is what happens when narrative, concentration, and flow mechanics start doing more work than business fundamentals. People forget that a fund can become its own market event. RK did. And because it was built on speculative growth in a low-rate world, the change in the rate environment hit it even harder. That is another lesson worth learning. If a business is valued mainly on distant future hopes rather than strong current cash generation, the price becomes extremely sensitive to long-term discount rates. When money gets more expensive, future dreams get discounted harder. That is not politics. That is arithmetic. So RK ended up exposed to almost every version of fragility at once. Speculative holdings, rich valuations, active concentration, liquidity pressure in underlying names, a self-reinforcing flow cycle, rate sensitivity. That is not a prudent structure for most serious long-term investors. Now let us turn to GDX, the gold miners fund. Here the confusion is different but equally dangerous. People think they are buying gold. They are not. They are buying mining companies. That distinction should be tattooed on the forehead of anyone discussing this category. Gold is one thing, a gold miner is another. Gold itself does not have labor disputes. It does not have management teams that overpay for acquisitions. It does not have cost overruns. It does not have environmental liabilities, political regime changes, reserve miscalculations, hedge mistakes, or capital allocation incompetence. Mining companies do. That is why buying miners and calling it gold exposure is often intellectually lazy. You are not buying the metal. You are buying operators, jurisdictions, balance sheets, and all the messy human decisions wrapped around extracting the metal. Mining businesses can be wonderful at the right price, with the right management and the right assets. But as a group, they have not exactly covered themselves in glory over long stretches. A great many mining companies have a habit of destroying shareholder value even in environments where the underlying commodity behaves well. That is an astonishing feat if you think about it. And yet it happens again and again. Why? Because capital allocation matters. Cost discipline matters. Jurisdiction matters, operational competence matters, and the mining industry as a whole has often shown a real talent for disappointing shareholders in precisely the moments when the story ought to be easiest. Now add leverage. Many miners are economically leveraged to the price of the commodity. That means you can get amplified gains when the metal rises. Investors love that in theory. What they do not love is that the same leverage works in reverse. When the metal stalls, when costs rise, when governments change the rules, when local currencies move the wrong way, when energy prices rise, when production disappoints, or when the company simply behaves stupidly. Suddenly, the thing that was supposed to give you turbocharged upside gives you very ordinary pain. And then there is geography. A mining fund is often stuffed with assets in places where political and regulatory stability cannot be treated casually. Tax regimes can change. Nationalistic pressure can rise. Permits can become weapons. Capital controls can appear. Local politics can turn a mine from an asset into an anxiety. Again, this is not gold. It is a very specific package of risks. So when I hear someone say he owns GDX for safety, I immediately know he has confused the symbol with the substance. A miner is not a bar in a vault. The same kind of confusion shows up in QQQ, but in a more fashionable form. People talk about QQ as if it were simply a sensible way to own innovation. That is too charitable. What QQQ really represents is a concentrated bet on a narrow slice of the market that happened to become the emotional center of the last great wave of performance. Now, let me be fair. Many of the companies inside QQQ are excellent businesses. Some of them are among the best businesses ever built. This is what makes the trap so appealing. You can say something true and still lose money if you pay too much or concentrate too hard. That is the adult version of investing. Wonderful business is not the same thing as wonderful investment. When over half the assets are tied up in a small handful of giant technology and technology-adjacent names, you do not have broad diversification. You have concentration wearing a respected costume. And because those businesses have been so successful, everyone wants them. Funds own them, institutions own them, retail investors own them, retirement plans own them, financial media discuss them endlessly. Analysts model them. Children can name them. That level of ownership should not comfort you automatically. It should make you ask a harder question. How much future success is already assumed in today's price? If a great company is already priced as though greatness will continue with only modest interruption for many years, then the upside from being correct about the quality may be limited, while the downside from even small disappointment can be meaningful. This is where people get hurt. They stop evaluating and start admiring. That is not the same thing. And its structure makes people feel diversified when they are actually making a sector bet with interest. Rate sensitivity layered on top. Technology-heavy portfolios live and die not only on earnings, but on the valuation investors are willing to place on those future earnings. When long-term rates rise or stay high, the present value of future cash gets compressed. That affects the businesses with the longest duration earnings expectations the most. So once again, you have a wrapper that looks sensible on the outside while hiding a very specific, very concentrated macro exposure on the inside. This is not to say QQ can never perform well. Of course it can. It already has. That is part of the problem. Success breeds complacency. People begin confusing a good decade with a permanent law of nature. They start thinking technology dominance and index concentration are risk reducing rather than risk concentrating. That is usually how great runs end. Not because the businesses are fake, because the investors' expectations became careless. Then there is EAM, the Emerging Markets Fund. Here the sales pitch is always the same. Faster growth, global diversification, youthful demographics, the future. I have heard some version of that story for many years, and I have also watched it disappoint a great many investors who assumed economic growth and shareholder return were the same thing. They are not the same thing. A country can grow and still treat outside shareholders poorly. An economy can expand while the listed companies inside it do not translate that expansion into strong returns for minority owners. Political power can matter more than economic efficiency. Currency weakness can erase local gains. Capital controls can turn accounting success into real disappointment. Governance standards can quietly poison what looked attractive at first glance. These are not side issues in emerging markets, they are central issues. And when you buy EAM, you are not simply buying growth. You are buying a complicated package of political, currency, governance, and ownership risks. Now, the most glaring issue in many emerging market funds is concentration. A person imagines he is buying a broad basket of the future. Often he is buying a large slug of China, plus a scattering of other jurisdictions, many of which come with their own problems. China is not a side holding in this kind of fund. It is often a dominating force. That means a person seeking diversification may in fact be making a fairly concentrated political bet while telling himself he has gone global. That is not my idea of diversification. If I want diversification, I want legal systems, shareholder treatment, accounting standards, capital markets, and currencies that do not all pull in the same kind of fragile direction. I do not want to solve domestic concentration by buying foreign opacity. That is not risk reduction. It is geography theater. There is also the issue of state influence. Many large emerging market businesses are not organized solely around shareholder returns. They answer to other masters as well. Government priorities, strategic policies, employment goals, political optics, national development agendas. The outside investor is not always first, second, or even third in the line of concern. He is simply present. That is a very different environment from owning a great business in a system more aligned with outside capital. Then there is currency. This is where many people quietly lose money without understanding why. The local economy may even look reasonably strong, but if the local currency weakens over time against the dollar, much of the shareholder result can vanish in translation. So now the investor is not only betting on growth and governance, he is also betting on currency stability across a group of places where stability cannot be taken for granted. Again, this is not impossible to win with. It is simply much more complex and much less attractive than the cheerful brochure language makes it sound. The final example is DY, the Dividend Aristocrat-style fund, built around long dividend increase histories. This one is especially dangerous because it appeals to exactly the sort of investor who wants to be responsible. He is not chasing memes. He is not buying dream companies with no earnings. He is seeking dividends, steady growing dividends. That sounds sensible. Sometimes it is. But if you build the whole methodology around what a company did with its dividend streak in the past, rather than around the underlying quality and future durability of the business, you can end up rewarding the wrong behavior. A dividend history is not a moat, it is evidence, and evidence must still be interpreted. A company can preserve a dividend streak through foolish means. It can underinvest in the business. It can take on leverage. It can do financial acrobatics to defend the appearance of stability. It can become a prisoner of its own public image. That is not the same thing as being a wonderful capital allocator. So when a fund screens heavily for dividend streaks, investors may end up with a basket tilted towards sectors that look mature and safe but are in fact crowded, rate sensitive, and in some cases structurally mediocre, utilities, REITs, staples, high payout sectors. These can all have a place at the right price, but when huge numbers of investors chase them specifically for yield, they stop being obviously safe. They become expensive relative to what they actually are. And once rates move, the crowding gets exposed. The yield hunter often forgets the price paid for yield. He looks at the income stream and ignores the capital risk. That is a poor habit. A stock yielding 4 or 5% can still make you materially poorer if the underlying business weakens, if the payout becomes unsustainable, or if the whole sector gets repriced because rates and sentiment move against it. Income is not the same thing as safety. That is one of the most useful sentences in this whole discussion. Now, after pointing out these 5 categories of trouble, I should say what I would rather own. That answer is much less exciting, which is another way of saying it, is probably more useful. I want broad diversification, real diversification, low-cost, wide exposure across sectors and company sizes. A structure that does not require me to predict the hottest theme, the next great disruption, the best mining operator, the right geopolitical bet, or the exact sectors that yield. Starved investors will overpay for next. For most people, a total U.S. stock market fund is a far better starting point than any of the crowded products I have. Just criticized, it owns the broad productive engine of American business rather than a narrow fashion basket. It does not require heroics. It does not require a cult. It does not depend on speculative small-cap innovation stories or on a tiny group of beloved mega-cap names doing all the work forever. It simply owns a great many businesses and lets the winners emerge over time. That is much closer to sensible investing for international exposure. I would much rather own developed international markets than pretend I am getting broad diversification through an emerging market wrapper dominated by political and currency complexity. That does not mean developed international markets are perfect. Nothing is. It means the legal and financial architecture is usually more dependable. That matters more than people like to admit. For inflation sensitivity, I would rather own direct inflation, linked instruments or well-chosen real assets than confuse miners with metals or narratives with protection. For dividend exposure, I would rather own truly exceptional dividend, paying businesses directly, or use a more carefully designed dividend growth approach than let a backward-looking streak methodology decide what belongs in the portfolio. And for technology exposure, I would rather get much of it through a broad market structure than through a crowded concentration vehicle that turns admiration into a portfolio policy. The main lesson here is not simply avoid these 5 funds. The deeper lesson is this: popularity itself changes the nature of an investment. A product can begin its life as sensible and become dangerous through the weight of the crowd. A theme can begin as underappreciated and become toxic through over-ownership. A methodology can begin as reasonable and turn foolish when too many investors pursue it mechanically. That is why I have always preferred businesses over categories and economics over wrappers. The wrapper is never the whole story. The structure underneath matters. And once too many people stop looking underneath, the danger grows fast. This is one reason I distrust anything described mainly by how many people own it. That is not an investment thesis. That is usually a stage of a cycle, when a fund becomes so common that people assume it must be prudent simply because it is common. I become more interested in asking what that popularity has already done to the underlying valuations, to the concentration, to the liquidity, and to the future return profile. That is the adult question. A serious investor does not ask only whether the wrapper is convenient. He asks whether the crowding inside the wrapper has already changed the risk. That is the question that keeps capital alive. I have never believed that following the crowd is the safest thing to do in markets. Very often, the crowd is safest at the beginning of a move and most dangerous near the point where everybody has arrived. The risk is not in being alone. The risk is in being one more person standing in a packed theater who assumes there will be no fire. That is how popular ETFs should be understood today. Not as innocent baskets floating above human behavior, as structures that can be transformed by human behavior itself. That is what too many people are missing. And that is why I would be much more comfortable owning broad, low-cost, less crowded exposure than paying for concentration, fashion, narrative, or methodological shortcuts that feel prudent only because they are heavily owned. Investment success is not built by joining every popular trade in a cleaner wrapper. It is built by respecting valuation, respecting concentration, respecting liquidity, and refusing to let social proof replace due diligence. That is the discipline I trust. It is not glamorous. It does not trend. It usually looks too boring right before it proves itself right. That is perfectly fine with me.